Cryptocurrency is often portrayed in extremes. Depending on who you ask, it's either the greatest wealth-building opportunity of the century or a highly speculative gamble destined to end badly. But what happens when you ignore the hype and take a simple, disciplined approach instead, rather than trying to predict market tops and bottoms? I decided to invest $500 into cryptocurrency every month for an entire year and track the results. Today, we will talk about $500 into crypto every month for a year. The real returns will shock you. So, before we get started, make sure to hit that like button. Also subscribe to my channel. 10. The first investment felt like taking a huge risk. The journey started with the first $500 investment. And the biggest challenge was not choosing a cryptocurrency. It was overcoming fear. Cryptocurrency has a reputation for creating massive gains and devastating losses. News headlines often focus on people who became millionaires overnight, or investors who lost their savings when markets collapsed. This creates powerful emotions of excitement and fear. The first month was filled with questions. What if the market crashes tomorrow? What if the investment doubles and I should have invested more? These thoughts control many beginner investors. The first lesson was realizing that successful investing is not about eliminating uncertainty. It is about creating a strategy that can survive uncertainty. 9. The market did not move in a straight line. One of the biggest surprises after investing every month was seeing how unpredictable crypto prices could be. Some months, the portfolio showed impressive gains, creating excitement and confidence. Other months, it dropped sharply, causing doubt and regret. A person who checked their account every day experienced an emotional roller coaster. One week, they felt like a financial genius, and the next week, they wondered if they had made a terrible mistake. This experience revealed an important truth. Short-term market movements are often impossible to predict. The ability to stay calm during both excitement and fear became just as important as choosing the investment itself. 8. Dollar cost averaging removed the pressure of perfect timing. Many new investors spend months waiting for the perfect time to buy. They believe they must enter the market at the lowest possible price and sell at the highest possible price. The problem is that nobody can consistently predict these moments. By investing $500 every month, the investor bought crypto at many different prices. When prices were high, the money purchased fewer coins. When prices were lower, the same amount bought more. This created an average purchase price over time and removed the pressure of trying to make perfect predictions. The biggest advantage was psychological, because the investor no longer had to constantly wonder whether today was the right day to enter the market. 7. The real challenge was staying consistent during crashes. Everyone loves investing when prices are increasing, and social media is filled with stories of huge profits. The real test comes when the market falls. During a major drop, the $500 monthly investment can feel like throwing money into a hole. Many people stop investing exactly when prices become lower, because fear takes control. This experiment showed that maintaining consistency during difficult periods was one of the hardest parts of the journey. A strategy only works if an investor follows it during both good and bad markets. 6. Research became more important than hype. Another major lesson was understanding the difference between investing and gambling. Many people enter the crypto market after hearing about a coin that supposedly has the potential to increase 100 times in value. They follow social media trends, influencers, or online rumors without understanding what they are buying. Over the year, it became clear that research matters. Understanding the technology, use cases, risks, competition, and development behind a cryptocurrency is far more important than following the excitement of the crowd. The investors who survive longer are often the ones who make decisions based on knowledge rather than emotions. 5. Volatility changed the meaning of money. Traditional investments may move slowly, but cryptocurrency can experience large price changes in a single day. Watching a portfolio increase or decrease by hundreds or even thousands of dollars can affect emotions dramatically. The experiment showed that investors must separate their emotions from market movements. Money invested in highly volatile assets should generally be money that a person can afford to keep invested for a long period or potentially lose. The biggest mistake would be investing money needed for rent, bills, or emergencies. Risk management became just as important as a possibility of earning high returns. 4. Small monthly investments added up quickly. At the end of 12 months, the total amount invested reached $6,000. Many people underestimate the power of consistent investing because each individual contribution appears small. However, month after month, the portfolio continued growing as more money entered the market. This was one of the most surprising discoveries of the challenge. Building wealth often does not start with one massive investment. It begins with small, repeated actions performed consistently over time, whether the portfolio increased or decreased in value. The habit of regularly investing became a valuable financial skill. 3. The biggest gains often came from patience. One of the most common mistakes in crypto investing is expecting instant wealth. Many people buy a cryptocurrency and expect their investment to multiply within weeks. When this does not happen, they sell their holdings and move to another popular coin. The experiment showed that patience is one of the most valuable qualities an investor can develop. The most successful long-term investors are often those who avoid making emotional decisions based on short-term price movements. They understand that markets move in cycles, and significant growth, if it happens, may take years rather than months. 2. The real return was more than just money at the end of the year. The final portfolio value was only part of the story. Depending on market performance, the investment could have been worth less than the $6,000 contributed, approximately the same amount, or significantly more. The most valuable return was education. The investor learned how markets work, how emotions influence financial decisions, and how important discipline is when dealing with volatile assets. Understanding risk, managing expectations, and developing patience became skills that could be applied to every future investment decision.
1. The biggest lesson was that discipline beats prediction. The number one discovery from investing $500 into crypto every month for a year was that successful investing is less about predicting the next big winner and more about following a consistent strategy. Many people spend their time searching for the perfect coin, the perfect entry point, and the perfect moment to sell.
The reality is that nobody can consistently predict the future of any market. The investors who often perform better over long periods are those who control their emotions, manage their risk, continue learning, and follow a plan. Putting $500 into cryptocurrency every month for a year creates an interesting financial experiment. The total investment of $6,000 could produce a profit, break even, or result in a loss depending on the cryptocurrency selected and the market conditions during that period. There are no guaranteed returns, and anyone considering crypto should understand its high level of risk and volatility. The biggest surprise is that the true value of the experience is not only measured by the number shown in the account after 12 months. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.